I just wanted to send you over some information that I think might be a little calming in this time of a lot of alarmism and doomsday conversation that we see. I'm seeing headlines from articles that are making it seem like the sky is falling and everything is falling apart. And I just wanted to give you some context or just maybe remind you a little bit of what to expect from the stock market, specifically the S&P 500, since that seems to be what everyone's talking about right now. So I wanted to just show you two things really quickly. Number one is this is showing you from 1980 all the way until just the other day in 2025. The red dot shows you the lowest point the S&P was at some point during that calendar year. So in the year of 1980, at some point, the S&P was down 17%. And then the gray bar shows you where it finished that year. So in 1980, at some point, the S&P was down 17%, but by the end of that calendar year, it had recovered that 17% loss and added 26% gain on top of that. So that's what you're looking at here as you kind of maybe zoom out on this a little bit and you look at the red dots and the gray bars. What you see is there's typically a pretty big discrepancy between the red dot and the gray bar. And when you average it out over the last 45 years, on average during any calendar year, the S&P 500 is down 14.1%. That's just the average. That's not the extreme like 2008 when it was down 49%. So this is just a little bit of a kind of reframing of the way to look at the market compared to the headlines or what we're seeing on social media. It just is so negative when in reality, we haven't even entered the average drop for the S&P 500 in a calendar year. So the really nice thing that helps me feel a lot better during these times is that even though the S&P on average does go down 14.1% at some point during a calendar year, the annual returns are positive 34 out of 45 years, or roughly 3 out of 4 years. So it just reiterates the case that we've already discussed about it's not about timing the market, it's about time in the market. And we certainly don't want to sell when we have a red dot because the gray bars are far more attractive and we can't get to the gray bars if we sell at the red dot. So, all those different diversification and patience type topics come to mind. And then the other thing I wanted to show you really quickly was I really find it odd as to the commentary and the dialogue out there, because if you look at the S&P 500 on a chart, this is showing you year to date for 2025. The S&P 500 is down 4.27% as of today. Again, the average during any calendar year is over 14%, and it's only down 4%. So we're not even close to the average. Yet the articles I'm seeing are, if I wasn't looking at this every single day, I'd be a little freaked out. If you zoom out to 6 months, you can see the S&P is down 1.5%. If you zoom out to a year, the S&P is up 8.25%. If you zoom out to 3 years, up 27%. If we zoom out to 5 years, up 130%. At 10 years, up 222%. And as far back as this goes, which is 1989, up 3,240%. So what you notice is there's this steady trend line where there's some dips, but it's a steady trend line up. And there are some significant dips, for example, in 2020, that was a rough year. 2008, obviously we had a big drop right here. But what's kind of interesting is you look at 2008 in the context of where we are now, you barely even notice that on the line. So the idea or the moral of the story really is that people are making all these huge statements and comments and rhetoric around year-to-date returns. And we're not investing for the year or the day, we're investing for decades. And if we look at it through that context, there's really no reason to be concerned. We've built a financial plan where you have your cash reserve first that you can use if equities go down more and we don't want to sell any. Then we have the appropriate amount in bonds. And if we take a quick look at one of the bond holdings that a lot of our clients will have, year to date, up 2.5%. So doing exactly what we want our bonds to do. They're going up when stocks go down. And then the third layer of diversification in the portfolio is our international stocks, because they tend to outperform when US stocks are doing poorly. And year to date, they're up almost 8%. So just wanted to send this to hopefully maybe as kind of a calming message in a time that's very riddled with anxiety, that we need to remember we're in this for the long game. We're not trying to day trade year to date and make the best return possible over the first quarter of 2025. We want to have a process-oriented system to maximize your returns over the course of your retirement, but also minimize the amount of risk you're taking to maximize those returns. So hopefully you find that helpful and somewhat soothing. Obviously, the news and the financial media can make things, they can spin things one way or the other, is really what it comes down to. And it really just comes down to selling marketing getting marketing dollars and selling advertisements. But when we really just do a quick reality check on where we are with the S&P, which is what they seem to be talking about the most, they being the financial media, we're down almost 5% year to date, which is not even halfway to the average that the S&P goes down in a normal given year. So hopefully that's helpful. Let me know if you have any questions, and hope the first quarter of the year went well, and I'll look forward to talking to you soon.